Welcome, everyone, to this deep dive. We're going to try to tease out some insights from this book, A Short History of Financial Euphoria by Kenneth Galbraith. And
Wow.
I think he had quite a
Oh, he did.
career economist, author, professor at Harvard and Princeton. He even tackled inflation during World War II.
A price czar.
Yeah, price czar, and then
Yeah,
U.S. ambassador to India.
a fascinating man. And in this book, he explores those recurring patterns of speculative bubbles throughout history. We think about the tulips, we think about the South Sea Company, and of course, the Roaring Twenties.
You know what makes people, seemingly sensible people, just throw caution to the wind when it comes to these bubbles?
Well, he suggests there's a common anatomy to these speculative episodes, regardless of the assets or the time periods involved. And it usually starts with something new and desirable coming on the scene.
Okay, like the latest gadget or something like that everyone has to have, and
That's it.
naturally the prices start to rise.
Demand explodes, prices go up. And that upward trend attracts even more buyers, generating a self-perpetuating cycle that pushes prices to those dizzying heights.
But we know what goes up must come down.
And it's seldom a graceful descent. When the bubble bursts, it's a sudden and often a devastating plunge, leaving a trail of financial wreckage.
So we have this pattern of boom and bust, but
Yeah.
what about the people involved? Galbraith talks about two types of participants.
He does. He talks about the true believers, and they're utterly convinced this time is different, that the market will ascend forever thanks to some revolutionary change.
They're drinking the Kool-Aid.
They are, absolutely.
But then there are those who recognize it for what it is. What about them?
Those are the astute gamblers. They acknowledge the speculative frenzy, but they're aiming to ride that wave as long as possible, squeeze out maximum profit before that inevitable crash.
Sounds like a very risky game of timing.
It is.
How do they know when to get out?
And that's where it gets really intriguing, because Galbraith delves into the psychology of these episodes, and particularly what he calls a vested interest in error. So the people who are profiting from the bubble become increasingly resistant to questioning its foundations.
So the more they gain, the more they buy into it.
Absolutely. It becomes a self-fulfilling prophecy. They convince themselves they're brilliant investors and not just lucky beneficiaries of a fleeting upswing.
And I imagine this is all compounded by what he describes as the condemnation of dissent.
Absolutely.
Anyone who raises a skeptical eyebrow is,
Ridiculed.
yeah, ostracized even.
Absolutely. We see this time and again. We think about Paul Warburg. He warned about the crash of 1929. He was accused of sabotaging prosperity. People even questioned his motives.
Roger Babson
Yes.
accurately predicted the crash, and he got vicious backlash from financial institutions and even fellow economists.
And it highlights those powerful psychological forces that are operating during those periods of time, because people become so emotionally invested in the bubble that they reject any information that challenges their rosy outlook.
So we have this pattern emerging, new miracle appears, drives speculation, and dissenting voices are quickly silenced. What about the innovations themselves? Are they really groundbreaking, or is there something else at play here?
Well, Galbraith argues that true financial innovation is remarkably uncommon. What's often touted as groundbreaking is really just a repackaged version of an old idea, and often involving debt creation and leverage.
I think we need to define leverage
Oh,
for the
absolutely.
listener who may not know what that is.
Sure. Leverage is essentially using borrowed funds to magnify your potential gains. So instead of just using your own capital, you amplify your investment with borrowed money, hoping for outsized returns.
So if the market moves in your favor, you make a lot of money.
That's right, but it's a double-edged sword. If the market turns sour, any downward movement is magnified, and it could potentially decimate your initial investment and leave you with a mountain of debt.
That's a lot of risk.
Higher risk, higher reward.
Yeah, okay.
And we see this going all the way back. For instance, early banks, they found that they could issue banknotes in excess of their hard money deposits, and that's essentially leveraging debt on a limited reserve of actual cash.
So they're just betting that not everyone's going to come for their money at the same time?
Exactly. Risky strategy. And sometimes it backfired spectacularly and led to bank runs and financial panics.
Okay.
We think about the holding company pros of the 1920s. People used borrowed funds to acquire shares in other companies, hoping to multiply their gains through this kind of intricate leveraged structure.
A real house of cards.
Exactly. And then there's the junk bond boom of the 1980s, repackaging high-risk debt into seemingly attractive investments, peddled by figures like Michael Milken, who initially was hailed as a financial genius, but later faced legal scrutiny.
Yeah, okay, so there's a recurring theme here. The allure of financial geniuses,
Uh-huh.
the tendency to blame external factors for the inevitable crash.
Right.
This time is a different idea. But let's look at some specific historical examples and see how these patterns have manifested throughout history.
Okay.
So let's go back in time to 17th century Holland, and we have this bubble involving something rather unexpected: tulips.
Tulipomania, it really exemplifies how powerful that speculative fervor can become. These vibrant blooms transformed into status symbol, and their value skyrocketed to just unimaginable levels. Single bulbs exchanged for estates, horses, even fully furnished houses.
It sounds absurd. How did this simple flower become the object of such intense speculation?
Well, tulips were relatively new to Europe, arriving from the East with an aura of mystery, exotic appeal, and their vivid colors, their unique pattern, they really captivated that Dutch elite, and they drove that demand through the roof.
So scarcity, novelty, classic ingredients for a speculative bubble. But how did it spiral out of control?
As prices rose, more and more individuals piled in, convinced they were investing in the next big thing. They borrowed heavily, leveraging themselves to the hilt, much like we see in contemporary bubbles.
Galbraith argues that even the astute gamblers often get caught in these things. Why is that?
Well, the allure of easy riches, it clouds judgment even for those who recognize the speculative nature of the market. And as prices keep rising, that temptation to stay in the game ride, the wave becomes almost irresistible.
Greed and fear of missing out.
Exactly. And let's not forget the social pressure. Everyone around you is seemingly getting rich. It's hard to resist the pull of the crowd.
Creates a collective delusion where rational thought just gets drowned out by the euphoria.
And as with all bubbles, the music eventually stops. Once that supply of new buyers dwindles, the market collapses. Prices plummet, leaving countless investors shattered and financially ruined.
A cautionary tale. Were there attempts to rationalize the crash, shift the blame away from the speculation itself?
Oh, of course, people attributed the collapse to everything from inclement weather to nefarious traders, anything but the underlying speculative mania, which was really the true culprit.
That tendency to deflect blame, to seek external scapegoats? It's a recurring theme throughout history.
It is?
John Law, his name is synonymous with financial schemes and speculation.
Uh-huh.
So tell us about him.
John Law was a fascinating character. He was a Scotsman transitioned from gambler to supposed financial mastermind, arriving in 18th century France, a nation that was burdened by debt and desperate for a solution.
Enter John Law with a plan.
With a plan, he proposed establishing a bank, the Bank Royale, empowered to issue paper money, backed by the vast untapped riches of Louisiana.
Louisiana, I mean, wasn't that mostly unexplored wilderness?
Indeed. But Law skillfully exploited those rumors of extensive gold deposits, and this ignited public enthusiasm and created a frenzy for shares in his newly formed Mississippi Company, which held exclusive rights to exploit Louisiana's purported treasures.
So he constructed a paper money system backed by nothing, really.
That's it. A classic example of leverage combined with masterful hype.
And it worked at least for a while.
For a time, individuals rushed to acquire shares, driving the price to astronomical heights. Fortunes were made overnight, which further fueled that speculative fire.
Sounds like those scenes from the Roaring Twenties, champagne flowing, everyone scrambling to strike it rich.
The parallels are striking. However, as one might anticipate, this grand scheme harbored a fatal flaw. It hinged on the continual discovery of gold in Louisiana, which, as you can imagine, never materialized in the quantities Law had promised.
Reality has a way of doing that.
It does.
So what happened when the truth came out?
Well, when doubts surfaced regarding the company's prospects, investors panicked, triggered a massive sell-off. The Bank Royale, lacking adequate gold reserves to support its paper money, crumbled, leaving countless investors financially devastated.
And the blame game started.
It did. Law, who initially was lauded as a financial savior, became the scapegoat, impelled to flee France in disgrace, and his name became synonymous with financial chicanery, even though he was arguably a victim of his own ambition and the public's insatiable thirst for quick riches.
Another compelling cautionary tale. Before we move on to more recent times, let's look at another classic bubble, the one that gripped England in the early 18th century, the South Sea Bubble.
Right, the South Sea Bubble. It offers a glimpse into the world of financial speculation and political maneuverings. It revolved around the South Sea Company granted a royal charter to engage in trade with South America.
South America again.
Again.
That seems to be a theme.
It is. The allure of vast untapped wealth served as a potent driver of speculation. However, the South Sea Company faced a minor obstacle.
I'm going to guess they were granted trading rights to a region dominated by
Spain. Precisely, Spain maintained a firm monopoly on trade with its American colonies.
So this company was founded on some pretty optimistic assumptions.
to say the least. However, they successfully persuaded investors and the British government of their potential, fueled by a very shrewd campaign of insider trading and blatant bribery.
The allure of corruption, insider dealings, a tale as old as time.
Indeed, and as shares in the company soared, attracting investors from every strata of society, a frenzy ensued, and when the company's inability to deliver on its lofty promises became apparent,
The bubble burst.
and the South Sea bubble's collapse reverberated throughout the British economy, exposing the fragility of a system built on speculation and deception, engendered widespread social unrest, a loss of faith in financial institutions. We've seen this in more recent eras as well.
These historical examples are captivating, but how does the American experience with speculation fit into this narrative? The U.S. has had its fair share of booms and busts.
Oh, the United States, with its deep-rooted belief in entrepreneurialism and the pursuit of wealth, it's proven particularly susceptible to these speculative episodes, from colonial paper money schemes to the railroad mania of the 19th century. The pattern replicates itself with remarkable consistency.
It's woven into the fabric of our financial history.
It is.
So let's look at some key American examples that illustrate this recurring theme.
That vast American landscape teeming with opportunity, it's really served as a breeding ground for speculative endeavors. We think about the land booms and bank failures that punctuated the 19th century.
Driven by that potent mix of easy credit and questionable lending practices, a recipe we've seen repeated many times, even in recent times.
Right. And then there's the railroad mania of the 1870s. Fueled by aspirations of connecting a nation and reaping enormous profits, investors poured their capital into rail lines, often exceeding actual demand and straining financial resources.
The era of the railroad barons and their empires built on steel but often on shaky financial foundations. Did this unbridled enthusiasm eventually lead to a reckoning?
It did. The Panic of 1873 brought this speculative bubble crashing down, exposing the perils of overinvestment and excessive leverage.
It seems like these crashes often reveal underlying structural vulnerabilities within the system, forcing a confrontation that can no longer be ignored.
That's a great point. And this pattern persisted into the 20th century. The post-World War I farmland boom, driven by soaring crop prices, easy access to credit that caused land values to surge. Farmers took on huge amounts of debt to expand their operations, only to be crushed when prices tumbled in the 1920s, setting the stage for the agricultural crisis of the Great Depression.
A stark reminder of how interconnected our economic systems truly are. A boom in one sector can have ripple effects that set the stage for future crises.
It can. Let's turn our attention now to the granddaddy of American speculative bubbles, the stock market crash of 1929, a period characterized by unprecedented euphoria, fueled by this belief that a new era of prosperity had dawned.
The Roaring Twenties, an era of jazz and flappers and seemingly limitless economic growth. But as we've learned, appearances can be deceiving. So what factors contributed to this particular bubble?
Well, beneath the surface danger lurked leverage in the form of margin-buying investment trusts. It inflated the bubble to really unsustainable proportions, and these financial geniuses emerged their supposed brilliance, captivating the public.
Familiar figures like Charles Mitchell, Albert Wiggin, even the esteemed economist Irving Fisher, all caught up in the speculative frenzy. Their pronouncements probably just made things worse.
Their assertions of a permanently high plateau for stock prices only added fuel to the fire, and as we know, all bulbs eventually burst.
And when this one did, the consequences were felt globally.
The events of that crash remain etched in our collective memory. The frantic selling, the plummeting prices, financial ruin spreading like wildfire. It laid bare the fragility of a system built on excessive speculation and unchecked leverage.
So are these historical parallels simply coincidence, or is there a deeper connection?
Well, the crash of 1987 bore striking similarities to its infamous predecessor, Reagan-era optimism, echoed the Coolidge-era leverage returned in new forms, and a new crop of financial wizards later faced legal troubles.
History repeating itself yet again. So what fueled this specific episode?
Corporate takeovers fueled by junk bonds. They mirrored the leveraged excesses of the 1920s. Michael Milken, initially hailed as a financial innovator, later faced legal scrutiny much like the fallen idols of 1929. And yet again, the crash was followed by attempts to blame it on outside factors instead of acknowledging the role of speculation.
It seems hard for people to accept that human behavior driven by greed and fear plays such a significant role in these events.
It is. The global nature of these episodes really underscores the enduring power of human psychology. The desire for quick riches, the fear of missing out, the belief in one's own special insight. These forces, they transcend geographical boundaries and historical periods.
So having explored these historical patterns, what lessons can we take away to protect ourselves from the next bubble? Are we doomed to repeat these cycles forever?
Galbraith suggests that the conditions that give rise to this financial euphoria, they've remained remarkably consistent across history. That cyclical pattern of optimism, greed, the illusion of insight, and the inevitable crash, it continues to play out.
And often the real culprit speculation itself is hidden by this search for scapegoats and external explanations. It's like we collectively look away from the uncomfortable truth.
He also highlights the limits of trying to regulate financial euphoria solely through legislation. It comes from deep-seated human tendencies, this desire for easy wealth that's hard to stamp out through laws alone.
So if regulations are not enough, what other options do we have? Is there a way to escape these recurring cycles of boom and bust?
That's a question I'll leave with you, our listener, to ponder. Perhaps we can distill the wisdom from Galbraith's exploration of financial history into a concise set of key takeaways.
Okay, sounds like a plan. That could be a helpful guide for navigating those tricky financial markets.
So first, recognize that speculative episodes are inherent to financial history. They pop up across different asset classes and geographical regions.
Second, understand that the anatomy of these bubbles remains fairly consistent, often marked by a new and desirable asset, rapid price appreciation, widespread euphoria.
Third, acknowledge those potent psychological forces at play: that vested interest in error, the condemnation of dissent that can cloud judgment and extend the bubble's lifespan.
Fourth, be cautious of claims of financial innovation, as they often involve repackaged versions of existing concepts, frequently employing debt creation and leverage to boost gains and risks.
Fifth, remember that even astute gamblers can get swept up in the frenzy. The allure of easy money and the fear of being left behind can override rational decision-making.
Sixth, be skeptical of pronouncements from so-called financial geniuses. Their predictions are often colored by the prevailing euphoria and their own personal interests.
Seventh, anticipate that when the bubble inevitably pops, efforts will be made to blame the crash on external circumstances or scapegoats, rather than acknowledging the role of speculation itself.
Eighth, appreciate that regulations, while crucial, are unlikely to completely prevent future bubbles, as they can't eliminate those underlying human tendencies that fuel these episodes.
Ninth, learn from history, study past bubbles to spot those common patterns and develop a healthy dose of skepticism toward market exuberance.
And finally, cultivate an attitude of prudence and critical thinking, understanding that market cycles are inevitable and that safeguarding your capital is paramount.
By absorbing these insights, we can equip ourselves with the knowledge and judgment needed to navigate the complex realm of finance, hopefully lessening the blow of future bubbles.
Well, thank you for joining us on this deep dive into the fascinating world of financial euphoria. Until next time, stay informed, stay vigilant, and as always, keep learning.